Welcome to Value Vest Daily, where we dig into the hot topics and big ideas in the world of investing. You know, for pretty much anyone trying to build wealth, especially if you're getting close to retirement, the big question is always the same, right? Where on earth can you find reliable, high-yield income? In today's world of low interest rates and crazy markets, that hunt can feel absolutely endless.
But what if the answer wasn't in the usual places? What if it was somewhere unconventional, kind of bridging the gap between old-school finance and the new world of digital assets? Well, that's exactly what we're going to get into today by looking at the story of one early retiree, Michael. We're going to take a deep dive into the high-yield strategy he's using, which is a really fascinating blend of the old and the new.
Okay, and before we jump in, the usual disclaimer, this is all for informational purposes. Think of it as a case study. It is absolutely not financial advice. You've always got to do your own homework.
So here's the game plan. We'll start with the big problem, that hunt for yield. Then we'll look at the companies shaking things up with a big bet on Bitcoin. We'll break down the specific tool they're using, meet their 4 different offerings, crunch some numbers to see what it all means, and then we'll talk about the risks. Ready? Let's dive in.
For years, the retirement playbook was super simple. As you got older, you just shifted your money into safe stuff like bonds. But let's be real. In today's world, a lot of traditional bonds just can't keep up with inflation. It's forcing people, maybe even you, to look for other ways to generate real cash flow without, betting the farm. And that's where Strategy Inc. comes in, led by its very well-known founder, Michael Saylor. Now, this was a 36-year-old enterprise software company, pretty standard stuff. But in 2020, they made a massive, groundbreaking pivot. They decided their corporate piggy bank wouldn't just hold cash. Nope, it was going to hold Bitcoin. And man, have they been stacking it up ever since.
So just how aggressive have they been? Get this. Strategy now holds over 3% of the entire circulating supply of Bitcoin. I mean, to put that into perspective, their corporate treasury is now playing in the big leagues, right up there with giants like Berkshire Hathaway and Amazon. That is a lot of Bitcoin.
Okay, so you're probably thinking, how does a company sitting on a mountain of Bitcoin create a high-yield income stream for people like me? And why would they even do it? Well, for them, it's a clever way to raise money to buy even more Bitcoin without taking on normal debt. And the tool they're using to do it, it's something that's been around forever, but is being used in a really fascinating modern way, the preferred stock.
Just think of a preferred stock as a hybrid. It's got the consistency of a bond, right? It's designed to pay out a nice, predictable dividend, but it's also a stock, so you own a piece of the company. Now, here's the key part. When it's time to pay dividends, preferred stockholders get paid before common stockholders. You're basically higher up in the line, which gives you an extra layer of security.
And I love this analogy. It really makes it click. If your investment portfolio is an orchestra, common stocks are like those wild lead guitarists. Yeah, they can pull off an incredible solo and make you rich, but they can also hit a really bad note. Preferred stocks, on the other hand, they're the string section. They provide that steady, consistent, reliable melody, the dividend, that holds the whole performance together.
Now, Strategy didn't just create one of these. Nope, they created a whole suite of them, and each one is designed for a different kind of investor. So let's meet the 4 players in their financial orchestra.
All right, first up we have STRC, or Stretch. This one is all about stability, kind of like a high-yield version of a money market fund. It pays a variable dividend every single month, which is awesome for cash flow, and the company's goal is to manage that rate to keep the share price right around $100. As you can see, it's got the lowest volatility of the bunch.
Next is STRD, or Stride. Now, this one is for the yield chasers. It's got a fixed 10% dividend on its original price, but since it's trading for less than that right now, the actual yield for someone buying today is a whopping 12.6%. So what's the catch? The dividend is non-cumulative, and this is super important. It means if the company misses a payment, they don't owe it to you. It's just gone. That's the trade-off you make for that giant payout.
Then you've got STRF, or STRF. This is the safety-first option. It also has that fixed 10% dividend, but here's the big difference. It's cumulative. So if they miss a payment, it just piles up like a debt that they have to pay you back before the common stockholders get anything. It's also the most senior of the 4, which means you have the strongest claim out of all the equity holders. And last but not least, STRK, or Strike. This is the one for people who want the best of both worlds. It gives you a solid 8% cumulative dividend, but, and this is a big but, it's convertible into shares of Strategy's common stock, MSTR.
So you get that steady income, plus you get a ticket to ride the potential upside of Bitcoin's price. No surprise, that extra feature makes it the most volatile of the four.
Okay, seeing them all laid out like this really makes the choices clear, doesn't it? You can see the trade-offs right here. You want stability and monthly checks? STRC. You're chasing that max yield and can stomach the risk? STRD is your play. You want the most protection possible? That's STRF. And if you want that income but also want some skin in the growth game, you're looking at STRK.
All right, so these percentages are cool and all, but what does this actually mean for your bank account? Let's make it real. Let's ask the million-dollar question, literally. What kind of annual income could you get from a hypothetical $1 million investment in each of these? Okay, let's say you put it all on STRD, the highest yield. You'd be looking at over $129,000 a year in income. That's a massive number, but you gotta remember, that comes with that non-cumulative risk we talked about.
What if you wanted that stability instead? With STRC, that same million would spin off over $105,000 a year. A little less, sure, but it's coming in every single month like clockwork. That's pretty amazing for budgeting your life.
And for our growth-oriented folks, the convertible STRK would bring in just over 93 grand. Yeah, it's a lower cash flow than the first two, but it's the only one that also gives you a shot at the share price really taking off.
And finally, STRF, the safest of the bunch. That million would generate almost $92,000 a year. It might be the lowest income of the four, but it's coming from the most protected seat in the house. You can really see that classic investment triangle in play here: income versus risk versus growth. You can't have it all.
Look, those numbers are really, really compelling. But let's be honest, high yield never comes for free. It's so easy to get hypnotized by the reward, so it's absolutely crucial that we take a clear-eyed look at the potential downsides. So there are really four main risks to keep in mind. First, market risk. If interest rates in general go up, the value of these could go down. Second, credit risk. You're counting on Strategy Inc. staying financially healthy to make those payments. Third is call risk. The company might be able to buy the shares back from you, especially if rates fall. And finally, subordination risk. If things go really wrong and there's a bankruptcy, the bondholders get paid back before you do. And all of this brings us to what might be the most important point of this whole discussion. Think of these as a potential steady stream of income, not a raging river. Building your entire retirement on any single company, I don't care how great it is just incredibly risky. It's like having only one well for all your water. If that well runs dry, you're in a world of trouble. Real financial security is built on diversification.
So that leaves us with the big question, right? Are these kinds of high-yield instruments the future of income investing? This cool blend of traditional finance and new digital assets? Or is it just too much risk, all concentrated in one company and one asset for someone planning a safe retirement? Well, the answer, as always, really depends on you, your research, and your personal tolerance for risk. Please subscribe, like, and share ValueVest daily to stay on top of topics covering your financial future. And hey, one more thing. Please put in the comments if you want us to deep dive any specific topic or ticker symbol. Thanks for watching.